In this video, you will learn how to evaluate stocks, and I will also provide you with tips for analyzing financial statements and researching industry trends. Makaya Wealth Building is dedicated to bringing to you the most important and most searched topic on finance and wealth building. Hello and welcome to this video on how to evaluate stocks. Whether you're a beginner or a seasoned investor, evaluating individual stocks is an essential part of making informed investment decisions. In this video, we will provide you with some tips on how to analyze financial statements and research industry trends to help you evaluate stocks more effectively. Firstly, let's start with financial statements. Financial statements provide a detailed overview of a company's financial health and performance. As an investor, you should look at the following financial statements. Income statement. This statement provides a summary of a company's revenues and expenses over a specific period. The income statement helps you understand how much money the company is making and how much it is spending to generate that revenue. Balance sheet. This statement provides a snapshot of a company's financial position at a specific point in time. The balance sheet shows the company's assets, liabilities, and equity. It helps you understand the company's financial strength, liquidity, and solvency. Cash flow statement. This statement shows the inflow and outflow of cash from a company's operations, financing, and investing activities. The cash flow statement helps you understand the company's ability to generate cash and how it uses that cash. Now that you know which financial statements to look at, let's discuss some important financial ratios that can help you evaluate stocks. Price to earnings ratio, P/E ratio. This ratio compares a company's stock price to its earnings per share. A high P/E ratio indicates that the stock is expensive compared to its earnings, while a low P/E ratio suggests that the stock is undervalued. Price to book ratio, P/B ratio. This ratio compares a company's stock price to its book value per share. The book value represents the company's assets minus its liabilities. A low P/B ratio indicates that the stock is undervalued, while a high P/B ratio suggests that the stock is overvalued. Debt to equity ratio. This ratio compares a company's debt to its equity. A high debt to equity ratio indicates that the company is highly leveraged and may be at risk of defaulting on its debt. Return on equity, ROE. This ratio measures a company's profitability by comparing its net income to its shareholders' equity. A high ROE suggests that the company is profitable and is generating a good return for its shareholders. Now that we've covered some financial ratios, let's move on to researching industry trends. Industry overview. Start by researching the overall industry to which the company belongs. Look for trends, growth rates, and any regulatory or political factors that could impact the industry's future growth. Competitor analysis. Analyze the company's competitors and compare their financial performance to the company you're evaluating. Look for strengths and weaknesses that could impact the company's competitive position. Management and leadership. Evaluate the company's management team and leadership. Look for experience, track record, and any notable achievements. A strong management team can drive a company's growth and success. Macroeconomic factors. Consider macroeconomic factors such as interest rates, inflation, and global economic conditions. These factors can impact the company's financial performance and growth potential. When analyzing financial statements, it's important to look at the company's revenue growth, profit margins, and cash flow. For example, if a company has consistently increased revenue and profit margins, it may indicate that the company is well managed and has a sustainable competitive advantage. Let's take Amazon as an example. In 2020, Amazon's revenue increased by 38% compared to the previous year, and its profit margin improved from 3.5% to 6.3%. This indicates that Amazon is a well-managed company with a strong competitive advantage, which could make it an attractive investment opportunity. Consistent cash flow. For example, a company with strong cash flow can reinvest in its business, pay dividends to shareholders, and pay off debt. An example of a company with strong cash flow is Microsoft. In 2020, Microsoft's operating cash flow was $71.5 billion, which was a 17% increase from the previous year. This indicates that Microsoft has a strong financial position and can continue to invest in growth opportunities. Financial ratios can provide insight into a company's financial health and can be used to compare it to other companies in the same industry. Let's take a look at some real-life examples. P/E ratio. The P/E ratio can be used to determine if a company's stock price is overvalued or undervalued compared to its earnings per share. For example, Apple's P/E ratio in March 2021 was 34.64, which was higher than the industry average of 22.26. This suggests that Apple's stock may be overvalued compared to its earnings. P/B ratio. The P/B ratio compares a company's stock price to its book value per share. For example, in March 2021, Coca-Cola had a P/B ratio of 10.51, which was higher than the industry average of 6.12. This suggests that Coca-Cola's stock may be overvalued compared to its book value. Debt-to-equity ratio. The debt-to-equity ratio can be used to determine if a company is highly leveraged and may be at risk of defaulting on its debt. For example, in March 2021, Tesla had a debt-to-equity ratio of 3.05, which was higher than the industry average of 1.09. This suggests that Tesla may be at a higher risk of defaulting on its debt compared to other companies in the industry. Analyzing industry trends and competitors can provide insight into a company's future growth potential and competitive position. Let's take a look at some real-life examples. Industry overview. The technology industry has experienced significant growth in recent years due to the increasing demand for technology products and services. This trend has benefited companies like Apple and Microsoft, which have seen significant revenue growth as a result. Competitor analysis. When comparing Coca-Cola to its competitors like PepsiCo and Dr. Pepper Snapple Group, Coca-Cola has a higher market share and stronger brand recognition. However, PepsiCo has a more diversified product portfolio, which could give it an advantage in the long term. Hey friends, if you are enjoying this video, consider subscribing and turning on the notification bell to receive a notification whenever I post a new video. Management and leadership. Under the leadership of CEO Tim Cook, Apple has continued to innovate and expand its product offerings, which has contributed to the company's financial success. Macroeconomic factors. The COVID-19 pandemic had a significant impact on the airline industry, which saw a decrease in demand for air travel. This negatively impacted companies like Delta Air Lines, which saw a decrease in revenue and had to take on debt to stay afloat. In conclusion, evaluating individual stocks requires a combination of analyzing financial statements and researching industry trends. By understanding the key financial ratios and conducting thorough research, you can make informed investment decisions and achieve long-term success. Thanks for watching and see you in the next video.